Good evening, I'm Vikram and this is the big question on NDTV Profit. Tonight we start at the world's tightest energy bottleneck, if I can call it that. We're talking about the Strait of Hormuz. Now that is that narrow blue ribbon that you're seeing over there. Yes, this is the part between Oman and the UAE on one side and Iran is on the other side. And yes, that is the most critical oil choke point on the planet. This is the one connecting the oil-rich Gulf to Asia, to Europe, and to North America. That's the important bit. Now, here's the squeeze, only 33 kilometers. At its narrowest, it is only 33 kilometers. Shipping lanes barely have 2 to 3 kilometers wide in each direction when they're moving. And yes, Tehran has often used it as that geopolitical pressure tool. So that is that important bit between Oman and UAE on one side, Iran on the other, which is why this is so crucial. The sliver of sea matters so much. It is the only sea passage out of the Persian Gulf carrying roughly a fifth of the world's daily oil and about 20% of global LNG, with nearly 80% of those cargoes headed towards Asia. Now disrupt that tap and prices, they don't just wobble, they jump, because insurers talk about shippers, you talk about traders. Oil price is the risk. Now for India, this is uncomfortably close to the bone. We import about 85% actually of our oil and nearly half of our crude and around 60% of our LNG. All of that sails through that important Hormuz Strait. With Russia flowing now, as far as those flows from Russia are concerned, yes, they're normalizing. Middle East barrels, they're back in the mix. More of India's crude has been coming through this particular corridor in recent times. So it is crucial again, which means a squeeze here could lead to a fatter import bill and also higher LPG, LNG sensitivity and freight and insurance spikes that show up in our inflation, in our household budgets. But yeah, you're probably thinking, we've seen this movie before. Wars push up oil prices, they go up higher first, then the market reroutes and then cools off. But it does not happen before a risk premium burns a big hole. So if you recall, during the Libyan civil war and also the upquake attack by the Houthi rebels in Saudi Arabia, crude oil prices they definitely went up. And during Russia-Ukraine, oil prices ripped past $120 a barrel before it started retracing. So even now, the headlines of Iran targeting oil flows, and that includes the Ras Tanura complex, they're enough to light a fire under Brent. From limited retaliation to the direct hits on Iranian infrastructure, from a Hormuz disruption to a broader regional conflict, the price ladder of oil is pretty clear. First, you add $5 to $10, then about $10 to $12, then you go past $90, and then in the worst case, you go past $100 a barrel. And every rung means a wider CAD, a current account deficit, will widen. There are tighter margins for oil marketing companies. The oil marketing companies definitely take the hit, and costlier aviation fuel, don't forget, that has a pain point of its own. Also pains for tires, for chemical companies, for cement. Any industry that is connected with crude derivatives is going to feel the pinch. Which is why tonight we're asking the big question, which is right up front on the screen. Iran war is now escalating. There is no doubt about that. We are seeing it unfold. Some people are saying it could become worse before it gets better. If it does escalate, what does it mean for our energy security? Is India prepared this time for an oil shock? Let's ask this question in a debate form, which is about the big question, and we've got an excellent panel to take this across to. Let me introduce you to them. Well, tonight on the show, we've got a great panel, like I mentioned, and indeed, it is a panel that will be able to take this on very well. Energy expert Narendra Taneja is with us, along with a diplomat with years of experience. Ambassador Anil Trigunayat is here. Biswajit Dhar is also joining them. He is a developmental economist and he's the former professor at JNU. Also chief economist at Kotak Mahindra Bank, Upasa Bhardwaj is with us, along with Sonam Srivastav, founder and CEO of Right Research. Thank you, ladies and gentlemen, for making the time and joining us. Let's quickly do A quick round of questions, short answers, please. If you can give me your elevator pitch view on India's readiness for an oil shock, given the escalation that we're seeing right now. Narendra Taneja, as someone who has tracked India's energy vulnerabilities now for decades, with half of our crude and most of our Gulf LNG passing through that Hormuz corridor, it's barely 33 kilometers at that kind of width when it's at its narrowest. Do you believe India is actually prepared for even a temporary choke in the Strait of Hormuz? What's your current risk reading right now?
Well, as I said, earlier, my worry is not, India's worry is not so much the movement of, oil through the Strait of Hormuz. Our worry is always the price. Oil is a globally, commodity and is benchmarked against the demand and supply of the globe. So number one, our worry is the price. Second is that Strait of Hormuz has never, ever been closed. So I'm still think that, Strait of Hormuz, probably Iran is not going to move in that direction. Two reasons for that. Number one, they know that in that case, Saudi Arabia, and Iraq and Kuwait, etc., they will also get into the whole thing and against Iran and maybe even intervene physically, militarily, wherever possible. And second, very quickly, I don't think the American forces are going to let them do it. But yesterday only Iran's foreign minister said there is no plan. They are not going to shut down the Strait of Hormuz. China will be the worst country affected, which is very close to Iran, in case the Strait of Hormuz is closed, shut down, or mined.
What do you say, Ambassador Trigunayat? You've seen regional diplomacy from up close. You've done it for years. Given this latest escalation, the strike on infrastructure that is linked to Ras Tanura, do you think India has enough goodwill, enough leverage across Tehran and Riyadh and Washington as well to keep our energy lifelines shielded if things go downhill from here?
Well, I think it's beyond India now. We have goodwill, there is no doubt about it. But at the same time, they are in a war. And Iran is in the fight to finish at this time. And therefore, they will deploy every single tool in their kit to bring about or inflict damage on the region as well as on the world, and Americans in particular, and Israel. So I think that we have just seen the beginning. There is an attack on the refinery in Saudi Arabia already, and the 150 ships that have been stuck. One of the oil tankers was sunk yesterday. So the situation is not at all going to improve in days to come. Now, while the supplies may be restricted, and I feel that the prices have gone up quite significantly, and a $10 adds to roughly about $1 billion, a 10% increase in that. That is also their calculations, which you have already yourself shown.
Yes.
And that will have a very big impact. Of course, we have about 45 days reserve with us. We can manage with them, but that is for other contingencies, not immediately for this. So we could perhaps bear this front. But the irony is that the Americans, they have been, forcing India to diversify from Russia,
right,
the oil.
Right.
And we started importing much more from Saudi Arabia in the meantime, or from the Middle East. And now they go and attack Iran and just constructing everybody else's. So you can buy from US, you can buy from Africa, you can buy from Latin America or Venezuelan oil, as they are talking about. But all that is also to pass somewhere. And those choke points are going to be pretty difficult for us, at least for going forward for 3-4 weeks. So that's a very difficult situation. Yes.
Correct. Biswajit Dhar, from your development and trade lens, these numbers are pretty stark because a 10% rise in crude can widen India's current account deficit by 30 basis points. Our import dependence still sits at 85%. So in your understanding, how exposed is India right now to the broader economic stability map? If crude holds above, say, $90 to $95 for a few weeks, how much damage can it cause?
No, I think this is going to be quite damaging for India because, for one, we have actually been able to bring our inflation under control. And that has actually helped our macro fundamentals a great deal. Now, if oil prices go through the roof, and there are expectations that it might go up to $100, $120 per barrel, now that is really bad news. Now, that is also going to put a lot of pressure on the rupee. We have already seen today there was considerable pressure on the rupee, and it's closed above $91. I think it hasn't happened for the past few weeks. So we are going to face this kind of a double warming.
Yes.
On the one hand, our rising current account deficit, and of course the inflationary pressures, and since we are so import dependent, the impact on the rupee, and unless RBI intervenes, and there are reports that RBI has intervened today, if RBI is not able to intervene effectively, then there is going to be another impact that the economy is going to be facing.
Let me ask Upasana Bharadwaj if she agrees. Upasana, the macro impact, it's generally the kind that shows up fast. Even a $1 rise in crude can add about $2 billion to our import bill. And then there is the LPG, LNG sensitivity, which is even higher. So in the current environment, all this global volatility that we are seeing, and it is rising, do you feel India has the monetary and the fiscal buffers right now to cushion a sudden oil spike without derailing the inflation trajectory?
A couple of things, Vikram, as you highlighted, there are different scenarios to work out with right now. It's just the beginning. We don't know whether it's going to last for 7 to 10 days or maybe more. Now, the question is, if it is a temporary phenomena, then I don't think much changes for the Indian fundamentals. But of course, if it does get overstretched and if the crude oil prices sustain above a certain level, then it's not just about the price, actually. It's about the supply side disruptions. At this point in time, we can talk about the strategic reserves which are adequate, which can take care of our requirements till a certain point in time. But I think the supply side disruptions, the logistic cost, the insurance cost, the risk premium attached to that, along with that, the cost of input prices going higher because of the supply side disruptions and the pass-through. And as Professor Dhar was also talking about, it's a double whammy. So we're talking about higher costs, not just of energy, but other input prices, along with that rupee weakening.
Yeah.
So there is a double impact coming into the picture.
Yeah.
So obviously, as we go through, and if this lasts, then clearly this does have significant adverse impact across the board, from current account deficit to inflation to overall GDP numbers. It will have a bearing.
Sonam, from the markets sense, we've moved sharply, of course, the markets have. Brent has jumped nearly 9% on the latest headlines. You're tracking sentiment in the markets. From where you're sitting, is this the start of a sustained risk premium phase for oil markets? Or do you think this is a classic fear trade that could unwind just as quickly if the tensions stabilize?
See, I think, we definitely expect the impact on the markets to be short-term in nature. If you analyze the impact of previous few wars, right? You would see that, okay, there's initial reaction that happens in the market, but then such corrections that happen in the market tend to be short-term, right? So we expect the market to stabilize soon, given this correction. But yeah, I think there are bigger worries coming because of the escalation of crude prices, the impact on growth in India, inflation rising up, and currency depreciation that would sort of play around with the market sentiment. So I won't say that the market sentiment would improve in a week or so, but yeah, I think it would stabilize sooner.
Now let's deep dive a little bit. Narendra Taneja, what do you say? I'm just getting news about Qatar Energy, and this is one of the world's top natural gas producers. And they are saying that they are going to halt their LNG production because of the Mideast war, now that it's raging on. They are talking about the pressures, which is why they are ceasing production of liquefied natural gas, of LNG and associated products. Do you sense there is going to be more of this? Let's get the core risk over here. If we see a limited weeks-long disruption in Hormuz, what does it convey to you? There is the slowed down insurance premium that goes up. What's your base case on how much crude actually gets delayed and for how long before rerouting any of this? Anyone, of course, from the panel who agrees, disagrees, please raise your hand to rebut. But I would like to get a view first from Mr. Taneja.
You see, there are two big issues here. Number one, that unless and until Iran decides to kind of, force closure of Strait of Hormuz, I think I'm not worried too much. And secondly, if Iran decides in terms of retaliation to move its boots, the army, into a neighboring country, let's say for the sake of discussion, which many people are talking about since morning, Kuwait, then of course the landscape changes. Then it means that Iran is basically prepared for a long drawn war. So far, if you go by the statements and the movements, it appears that Iran is not prepared for a long drawn war. And the US certainly is not, and Israel is not. So in such a scenario, my own sense is the next 7-8 days are going to be tough in terms of the war. American and Israelis are going to do the maximum possible damage to Iranian infrastructure, electricity, water, and overall infrastructure, and try to do as much as possible. Then leave it to trigger a kind of a response from the people on the ground to go for a regime change. Take 6 months, 1 year, nobody knows. In such a scenario, I think we don't need to worry too much. My own sense is oil prices may go up, may even touch $95, $100 per barrel, and so on and so forth. But after that, they will go back to where they should be in terms of demand and supply fundamentals. So I'm not worried. I'll wait for 7-8 days. My own sense is, first and foremost, American economy, President Trump himself and his party, they cannot afford oil prices to touch 90 or 100 and stay there for a longer period. Politically, his party is facing elections very soon, and they just cannot afford it. And my sense is they have done their geopolitical mathematics, which is basically 8 to 12 days window. Within that, they are going to manage the oil prices, gas flow, and so on and so forth. At the same time, make sure that the whole thing does not escalate. So that's the assessment most people have in the circle that I move in, globally, in energy geopolitical circle. But as far as Qatar is concerned, those fields, as you know, ExxonMobil is the biggest investor in the field you're talking about, the LNG. And the second thing important to remember, that a refinery has been already bombed, but that is a small refinery. I've been myself there several times. Not too so much worry. So far, oil is flowing. Oil wells across the region are functioning well. The only disruption is the tankers are not able to. Not that there is any kind of, has been shut down, no such thing, but they're just precautionary, because Iranian forces send a radio message to all the tankers around, don't try to cross, otherwise we'll bomb you. But they have not bombed any ship so far.
Not bombed any ship, but if tensions do rise, as they seem to be, Ambassador Trigunath, do you think India can get some quiet assurances from Riyadh, from Abu Dhabi, from Doha, and Tehran perhaps, to prioritize Indian liftings? Or do you think the great power dynamics are going to overshadow the kind of bilateral goodwill we have been able to generate? What is India's best back channel lever at the moment?
Well, I think we have been talking to all the people there. Dr. Jaishankar has spoken to Iranian foreign minister and all the foreign ministers of the region. But that was mainly in the context, of course, energy security, but on the context of the safety and security of about 10 million Indians who are there.
Correct.
So I think that has been one of the immediate priority for India. And therefore, what India wants essentially is to de-escalation, dialogue and diplomacy. That's precisely what we're trying to push for. The Prime Minister himself has spoken to Netanyahu as well as to the UAE. So all these countries, they have to sell their oil. And I believe the OPEC might go in for increased production as well. But the problem of passage, and I hope that what Mr. Thareja has said could be true, and let's hope it remains that way. So 7-8 days, 10 days, 15 days can be managed. But beyond that, I think it is going to definitely have an impact. As far as Iran is concerned, it needs an off-ramp. Now to be able to, they might look for some kind of an adjustment or, for example, just calming down. But for that, the Americans are also in a lot of problem at the moment. Firstly, they waged this illegal war. It is internationally illegal as well as illegal domestically, for the US Congress has not authorized it. So they are trying to call it as some kind of a special anti-terrorist operation and all that. So this can't go on when the body bags start reaching. So the Americans will be under greater pressure to de-escalate also. So let's hope that good sense eventually prevails.
Correct.
We have not seen that very much.
Yes. So the hopeful version of this is that there will be a de-escalation, because the US cannot afford to keep this going from a political standpoint and not keep oil at elevated levels around $100 to the barrel. But Biswajit Dhar, assuming that Brent stabilizes in that region of $90 to $95 a barrel, and if that happens for a few weeks, then what is the impact? How does that filter into the current account deficit? How much pressure does it build on the rupee and the imported inflation in the near term? How much of this could actually percolate? And if you are going to tell us that it does have a big impact, then what's the one macro buffer that India should lean on first?
No, look, if the oil prices today, Brent is about $82 a barrel, and if it goes up to $90-$100 a barrel, then there is surely going to be an impact on oil prices and therefore inflation in India. And if that happens, I think all the calculations that RBI has, the inflation targeting and and all other things follow. How to manage the inflation and whether interest rates will then be impacted and all. Then you go into a whole sort of a tailspin, and you're looking at a scenario where the RBI was actually gradually bringing down the interest rates and trying to provide some impetus to private investment. Now that is going to be seriously impacted. Now look, the kind of exposure that we have to imports, and if you look at the way our import dependence on China, for instance, has been continuously increasing, and this year is going to be crossing $100 billion. The deficit is going to be more than $100 billion. And with all these free trade agreements which are happening, the first impact of these FTAs is going to be increase in imports, and then exports usually follow rise in imports.
Correct.
So we are going through a situation of adjustment already, and on top of that, we have this sort of imported inflation that you talked about.
Yes.
Which is going to be a tall ask for our macroeconomic stabilization.
Exactly. Upasana, do you want to weigh in on this? If crude pops $10 to $12 from this point, do you see the Monetary Policy Committee's reaction function changing? Hawkish rhetoric, extended pause, perhaps a bias to shield growth given supply side nature right now? What's your CPI glide path risk right now?
Okay, so just two things. I think on an average, if you look at the expectations on crude oil prices before this crisis, across the markets were in the range of $60 to $70.
Correct.
That was a range of assumption that mostly markets were going with. So from there, we are already $10 ahead, right? Now we're talking about another $10. So if you're talking about an average crude oil prices going up by a $20 a barrel, then that clearly brings in a very big risk, because we're talking about 0.8% of an impact on CAD. This is only the first leg. The second is when excessive current account deficit pressures build up, and when crude oil prices go higher, then whatever small amount of FPI inflows have started at the margin, we do start seeing a significant risk there as well, because flight to safety starts again. I mean, we've already started seeing that impact on silver and gold again.
Correct.
So I think here it is, again, a double problem. We're talking about a balance of payment deficit worsening from the current levels. That's one. Having said that, I think we should keep in mind a couple of things, that if it doesn't really go beyond a couple of months, this problem, then I don't see too much of a risk persisting. I think we will revert back to normalcy.
Okay, fair enough.
Secondly, there is an excise duty cut. There is an excise duty cut which the government can use as a lever. Of course, it does put pressure on the fiscals, but one of the institutions have to bear the brunt of it. Right. So I guess the government, if a pressure is arising, will take that onus on itself, and the government could potentially go ahead with a excise duty cut, to ensure that we don't really see a pass-through to the consumers as much. So somewhere the monetary policy could get that kind of a leeway,
right,
coming from there.
Yeah.
Overall, the roadmap on inflation at the moment is comfortable. We can afford a little bit of spillover, of course, depending on the sustainability of this problem.
The sustainability of the problem is the big ask. And Narendra Taneja, one wonders if one has to change our sourcing mix. Russia flows are variable. Middle East barrels, they are the dominant piece. Is it time to re-diversify? Are we to look at West Africa, the US Gulf Coast, Latin America, even at higher freight, just to reduce the risk of that choke point, which is Hormuz? What's the realistic remix that you see possible in the next 90 days? And very quickly, if I may ask you, since we're running out of time.
Well, we have already done that. Today, we are importing crude oil from 41 different countries, including from Guyana. We even import from northern Norway in the Arctic region. We have done all that. I think that the issue right now is that I don't really think, I'm looking at basically two ways. The next 10 days, my own sense is things are going to get back to more or less normal. Oil will start, flowing through the Strait of Hormuz under military or without military. We'll have to wait and see. But I think the flow will start. I really don't see. And then the oil prices will go back to where they should be. If you go by demand and supply fundamentals, Brent today should not be more than $60 per barrel. There is no supply disruption as of now at this stage. So I'm not too worried. Let's allow us 10 days. And I think 10 days, if things will, my own senses will be sorted, will sort out. And if that does happen, if it's Iran decides to retaliate in different ways, closing the Hormuz or moving boots into the other countries, then the very different scenario. And if in that kind of scenario, oil prices may go beyond $120 per barrel, not only in India, the world is not prepared for it.
All right, so one needs to kind of figure out what's the kind of worst case scenario right now. Maybe a three-step emergency playbook for India, whether it's diplomacy, it's logistics, it's about finances. Getting that piece organized is going to be something that India will have to do. The Hormuz risk is real, and that is really primary. But time-bound disruptions can be managed with diversified sourcing and disciplined approach to our reserves. Two, of course, the shock transmits fastest through inflation and the current account. So targeted and temporary cushions, they could beat the blanket fixes. And three, of course, markets will overprice risk first, but portfolios can be smartly reset while policy leans on diplomacy and on logistics. My thanks to Narendra Taneja, Anil Trigunayat, Biswajit Dhar, Upasana Bharadwaj, Sonam Srivastav. Thank you very much for joining us with your insights on the big question. And that about wraps it up on this edition. But of course, our eyes and ears are all peeled towards what happens next when it comes to the trouble in West Asia. How much damage can it do to the global economy and indeed the growth path that India is on? That's a piece that we are tracking very closely. But for the moment, here's where we're wrapping it up. I'm Vikram Oza from me and the team. Thank you. Good evening.